Make volatility your friend. We know what volatility means. It means something scary, something unpredictable. An investment is volatile when it fluctuates in its value over a period of time. The more the fluctuation, the greater the volatility. And it's risky, because these uncertain fluctuations may affect your investments negatively. Oh yeah, you don't want to risk your hard-earned money to the volatility in the market.
Though I'm not sure if that's the only way to look at risk. If one looks at risk in the context of investing, and it becomes the variability of returns from an investment, changes the meaning quite a bit, doesn't it?
You're quite right. The general definition of risk only foreshadows the possibility of loss, while in the context of investing, it offers that and the possibility of an unexpected upside.
This is what volatility is all about. It is bidirectional. It makes prices move in both directions, down and up. And the risk is relatively higher when it comes to investing in equities.
So how do you work around it? How do you use it to your advantage and make it your friend? Well, if you're just a little smart about the upcoming weather in the stock market, you can really turn volatility into a powerful weapon and use it against itself. Seriously, it's time to beat volatility at its own game.
And for a beginner, there's a very simple start. Systematic investment plan, a way to invest regularly. All the investor has to do under an SIP is to invest a fixed amount at regular intervals. Really, that's all.
So how does this strategy beat volatility, you ask? Take a look. Suppose you invest Rs 5,000 every month to buy units of a mutual fund scheme. Obviously, the number of units bought will depend on the NAV per unit at the time of purchase. So if the NAV per unit is Rs 12.50, you get 400 units. But if it went down to Rs 10, you get 500 units. This means you actually took advantage of the volatility occurring in the market and bought units at their current rate. Sometimes getting less, but also sometimes getting much more. There you go. That's you beating volatility. And this can continue to happen without any effort from you, apart from the discipline of investing regularly. Buying more when the price is low and buying less when the price is high. Much like you going to the mall during a sale to pick up bargains.
On the other hand, if you have a lump sum amount, you can also benefit from volatility by opting for a systematic transfer plan. You can invest the lump sum amount in a liquid fund and periodically transfer portions into a chosen equity fund. This way you get the same benefit as an SIP, in addition to deploying a lump sum more productively.
Yeah, you don't need to commit your lump sum investment to an equity fund, but instead invest in a liquid fund and get the power to play the field. It gives you the flexibility of realigning the bifurcation of your fund investments and hence your returns. That's you beating volatility once again.
The point is to realize that the volatile movements of equity investments even out over time. Therefore, a long-term strategy is important because when stocks go up, it helps long-term investors who are bought during periods of volatility.
Remember to stick to a disciplined plan when buying regularly and don't panic if prices become volatile. Because the secret really is that if you make volatility your best buddy, it'll do you good. We hope you've enjoyed watching this video. Watch more and we'll help you learn about different investing concepts. You can also write to us with your feedback at editor@templeton.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.